Good morning. I am Lakshmi Pratay MG, Assistant Professor of Commerce, Government First Grade College, Madhugiri, Tumkur District, Karnataka State. My title is Financial Accounting 2. So now I am discussing about session number 26. The topic is Sale of a Firm to a Limited Company. Under this session, I am discussing about recording of closing journal entries and preparation of ledger accounts in the books of vendor firm. So first I am taking one problem. Ram, Rahim and Robert are in partnership, sharing profit and losses in the ratio of 4 is to 3 is to 1 respectively. On 31 3 2018, they agreed to sell their business to a limited company. The balance sheet on that date was as follows. Under liability side, capital Ram, Rahim and Robert. Ram's capital is 80,000, Rahim's capital is 60,000 and Robert capital is 52,000. So loan from bank 16,000. Sundry creditors 32,000. The total liability side 2,40,000. Coming to asset side, freehold property 72,000, machinery 48,000, book debts 60,000, stock 52,000, cash 8,000. 2,40,000 is the credit asset side total. In this balance sheet, capital of and loan from bank sundry creditors and fixed assets and current assets are given. These three partners sharing profits and losses in the ratio of 4 is to 3 is to 1. That is 4 divided by 8, 3 divided by 8 and 1 divided by 8. Next, the company took the following assets except cash as the valuation shown below. The purchasing company took over the following assets except cash. That is freehold property at rupees 88,000. Machinery at rupees 44,000. Book debts at rupees 56,000. Stock 48,000 and goodwill 16,000. The company also agreed to took over creditors at rupees 3,800 but not took over bank loan. The company paid 6,600 shares of rupees 10 each fully paid and the balance in cash. The expenses amounted to rupees 2,000. The question is pass closing journal entries and also prepare necessary ledger accounts in the books of vendor firm. So in this problem, the purchasing company taken over certain assets at agreed value is given in the problem, given in the adjustment. And even also the company agreed to take over creditors at rupees 30,800, but the purchasing company not taken over the bank loan. So if in that situation the bank loan will be paid off. So the discharge of purchase consideration is given in adjustment, that is the issue of 6,600 equity shares of rupees 10 each fully paid, and remaining balance of PC in cash. The realization expenses amounted to rupees 2,000 is given in the adjustment. Okay, first we prepare the closing journal entries in the books of the vendor firm. So first there are 4 steps involving in sale of a firm to a limited company. The step number 1 is calculation of purchase consideration. There are 3 methods of calculation of purchase consideration. The one is net payments method, lump sum method, and another one is net assets method. In this problem, lump sum and net payment method are not applicable. So in this problem, we are calculation of PC by using net assets method. The second step is discharge of purchase consideration, and third step is closing the books of the vendor firm. Under this step, we prepare closing journal entries in the books of the vendor firm and also prepare closing ledger accounts in the books of the firm. So the question is asking, we in this problem we are preparing 3 steps, not step number 4. So let's discuss one by one. First we calculate PC by using net assets method. What is the way? So net assets method is equal to purchase consideration is equal to total assets taken over by purchasing company at agreed values minus total liabilities taken over by purchasing company at agreed value. So in this problem, the purchasing company taken over the freehold property at rupees 88,000, and even machinery also taken over at rupees 44,000, and book debts also taken over at rupees 56,000. Stock also taken over at rupees 48,000. Goodwill for 16,000. Total assets taken over by purchasing company at agreed values is equal to 2,52,000. Out this amount we deduct total liabilities taken over by purchasing company at agreed value. In this problem, two liability side, on liability side only creditors and bank loan, but in this problem purchasing company is not taken over by the bank loan, only taken over creditors at 30,800. So we deduct creditors from 2,52,000. So we get purchase consideration is 2,21,200 by using net assets method. Next stage, discharge of purchase consideration. In this problem, clearly informing by issuing of equity shares of 6,600 equity shares of rupees 10 each. So 6,600 into 10, 66,000 amount of PC is discharged in the form of equity shares. And what is the total PC? 2,21,200 is the total purchase consideration. But in the balance in the form of cash is equal to 2,21,200 minus 66,000. So we get balancing figure in the form of cash 1,55,200. So this type of way of discharge of PC. The next stage is preparation of ledger accounts in the books of vendor firm. What is the first entry? First entry is transfer of assets at book value to realization account. What is the entry? Debit the realization account, credit to freehold property, that is not adjustment value, book value, balance sheet value we are taking into realization account. Only adjustment amount or agreed amount we are taking for calculation of PC and incorporating journal entries. So one by one we are entering book value at balance sheet. Freehold property 72,000, machinery 48,000, stock 52,000, book debt 16,000. The narration is being transfer of above assets at book value to realization account. What is the opposite entry? Transfer of liabilities at book value to realization account. The entry is creditors account debtor 32,000, bank loan account debtor 16,000, to credit realization account 48,000, being transfer of liabilities at book value. So in this problem, even bank loan is not taken over by the purchasing company, whatever it may be, either taken over or not taken over, but we are crediting first, crediting the first credit the realization account, and then afterwards we are paid off. So mind it, if it is taken over, you credit. If it is not taken over, credit. Then only you apply the rules and regulation after crediting the liabilities and after debiting the assets also. So next another entry is purchase consideration due. Purchasing company account debtor, what is the total PC? 2,21,200, and credit the realization account 2,21,200, being purchase consideration is due. And next in this problem, some expenses on realization account is given, that amounts to 2,000 is given in the adjustment. That expenses on realization accounts are debited to realization account. The entry is realization account debtor 2,000 to credit cash or bank account 2,000. The narration is being expenses on realization account paid. And next, so in this problem, bank loan is not taken over by the purchasing company. First we credit side of the realization account and immediately debit the realization account, that is we paid. So we paid means debit the realization account 16,000 and to cash our bank account also 16,000, being bank loan paid off by the vendor firm. Next entry is sixth one. What purpose we prepare realization account? To find out or ascertain the profit on sale of a firm to a limited company. In this problem, we have some profit. That profit debited to realization account and credited to partners, concerned partners capital account. So what is the total profit? 19,200 to Ram's capital. We are divided the 19,200 on the basis of their profit sharing ratio. So Ram's capital got 9,600, Rahim's capital got 7,200, and Robert's capital share is 2,400, being profit on realization account transferred to partners capital account on the basis of their profit sharing ratio. The next entry is, so equity shares in purchasing company account that are 66,000, cash or bank account that are 1,55,200, to purchasing company account 2,21,200, being the receipt of purchase consideration. The next entry is Ram's capital account debtor, Rahim's capital account debtor, and Robert's capital account debtor. The entire amount of PC paid in equity shares are distributed in final claim ratio, because in this problem no information is given about the distribution of shares. So we, on the basis of absence of information in the problem, so we are sharing the shares on the basis of final claim ratio. In any problem, if any information is given about the distribution of shares, then that type of procedures we are following. Suppose in any problem, absence of information regarding the distribution of shares, so that situation we have to find out the final claim ratio. On that basis, we have to distribute the shares in final claim ratio. What is the final claim ratio? We are working on lastly note. So by referring laterally, we referring notes. So Ram's capital got 28,000 and Rahim's capital 21,000 and Robert's capital 17,000 to equity shares in purchasing company, that is 66,000, being distribution of shares in final claim ratio. And finally, Ram's capital account 61,600, Rahim's capital 46,200, and Robert's capital account 37,400, and to cash or bank account 1,55,200. Next, so these are the we are passing journal entries in the books of the vendor firm. Now we are discussing about ledger accounts in the books of the vendor firm. So what are the different ledger accounts we are preparing? Among the first ledger account is realization account. What purpose we prepare realization account? To identify, to find out the net profit or loss on realization account. So in realization account, debit all assets except cash. So in this problem, clearly informing us, so do not transfer the cash value to realization account, because clearly informing. So debit the freehold property 72,000 at book value, debit the machinery account 48,000, debit the stock account 52,000, debit book debts 60,000, and creditors 32,000 and credit bank account 16,000. So in this problem, bank loan is not taken over by the purchasing company. So immediately we pass another entry for debit side. So come to debit side, to cash or bank account, bank loan paid, that is 16,000. So the profit, the credit bank loan will be automatically paid by debiting the cash or bank account. And purchasing company, that is purchase consideration of the amount is 2,21,200, we are crediting to realization account. And finally, in this problem, some expenses are incurred on sale of a firm to a limited company, that is debiting to cash account 2000 and expenses are paid. And finally, the credit side balance is 2,69,200 and the debit side difference is 19,200. 19,200 is treated as profit on realization account, transferred to partners capital account on the basis of profit sharing ratio. What is the RAM shares? 19,200 into 4 by 8 is equal to 9,600, and Rahim share is 19,200 into 3 by 8, 7,200, and final Robert share is 19,200 into 1 by 8 is equal to 2,400. So 9,600, 7,200 and 2,400. Next, we prepare partners capital account. Partners capital account, first we credit the balance brought down their capital, say 80,000, 60,000, 52,000, and credit the realization account profit, that is 9,600, 7,200 and 2,400, and immediately debit the distribution of equity shares given by the purchasing company on capital ratio, on final ratio 20, that is Ram's share is 28,000, Rahim share is 21,000 and 17,000 is the Robert share. And finally the difference amount is called a balancing figure. That balancing figure is in the form of cash account, that is Ram's 61,600 and Rahim's 46,200 and Robert 37,400 is the balancing figure. And next, we prepare equity shares in purchasing company. The debit, first we debit the purchasing company 66,000 and credit the entire 66,000 on the basis of final claim ratio. So Ram's capital account 28,000, Rahim's capital account 21,000 and Robert's capital account 17,000. So total 66,000. Next, so another one is purchasing company account. It is very easy. So to realization account 2,21,200 debit. So in realization account it should be credit. So on the basis of credit, then we debit the realization account. In realization account, the purchasing company are credited, but in purchasing company, the realization account should be debited. And entire 2,21,200 is paid in the form of equity shares and cash. That is equity shares in purchasing company account, credit 66,000 and credit cash or bank account 1,55,200. The total is 2,21,200. And next, we prepare cash or bank account. So almost receipts and payments are equal. First we debit the opening balance, because the cash balance is not transferred to realization account, because in this problem clearly informed cash is not taken over by the purchasing company. On that basis we have to enter on debit side to balance brought down 8,000 and even purchasing company also given in cash, that is we are entering into debit side it means not particulars, it means receipts. So the total receipt we have cash 1,63,200 and credit by realization account, that is expenses paid rupees 2,000 we paid it, and realization account, again realization account are crediting, that is banks loan also paid 16,000. And finally Ram's capital account 61,600, Rahim's capital account 46,200, and Robert capital account 37,400 is the final answer. So debits receipt side is equals to payment side. And then working notes we are calculating in this problem, for the distribution of in this problem, what is the distribution of shares, on that what basis it is not given. So on that based on the absence of information in the problem, so we have to calculation of final claim ratio or final capital ratio. So first we take all debit side total of partners capital account, that is Ram's capital 89,600, Rahim's capital 67,200, and Robert's 54,400 is the debit side of the Ram's, debit side of the capital account, debit side of partners capital account. Unless credit side total, credit side total is nil, and we if any credit side total is, it must be deducted, but in this problem no credit balance, and final capital balance is 89,600, 67,200, 54,400, that is final claim ratio is equal to Ram is to Rahim is to Robert, 89,600 is to 67,200 is to 54,400 are is equal to 448 is to 336 is to 272. Therefore final claim ratio is equal to 28 is to 21 is to 17. On that basis we are dividing the distribution of shares. So calculation of distribution of shares to partners is Ram's, that is 6,600 into 28 divided by 66 is equal to 2,800, and equity shares of rupees 10 each is equal to 28,000. Rahim's 6,600 into 21 divided by 66 is equal to 2,100, equity shares of rupees 10 each is equal to 21,000, and Robert share is equal to 6,600 into 17 by 66 is equal to 1,000. 700 equity shares of rupees 10 each is equal to 17,000, total 66,000. Next, try yourself, A, B and C are in partnership firm, sharing profit and losses in the ratio of 5:3:2 respectively. On 31st/3/2019 they agreed to sell their business to a limited company. The balance sheet on that date was as follows. In liability side, capital of A, B, C is given. A 3 lakh, B 1,80,000, C 1,50,000, and loan from bank 50,000, and sundry creditors 1,50,000, total 8,30,000. In asset side, building 4,50,000, machinery 75,000, book debts 1,75,000, stock 1,25,000, cash 5,000. Total asset side is also 8,30,000. The company took the following assets except cash as the valuation of shown below. Building 5 lakh, machinery for taken over at 50,000, book debts 1,60,000, stock rupees 1,30,000, goodwill 1 lakh. So the company also agreed to took over creditors at rupees 1,40,000, but not took over the bank loan. It means it to be paid off. The company paid 50,000 shares of rupees 10 each, fully paid, and the balance in cash The expenses amounted to realization account is rupees 25,000. The question is pass journal entries and prepare necessary ledger account in the books of the vendor firm. So these are the references for your further study. Thank you very much.